So far in this series, we have talked about the Roth IRA, how it compares to the traditional IRA, other retirement accounts, how it grows, tax-free. What if you wanted to do more than just invest in stocks, ETFs, and mutual funds? What if you wanted more options? Maybe you want more control. Maybe you think you can get a significantly better return investing in other things. This is where the self-directed Roth IRA comes in. A self-directed Roth IRA still has the same basic set of rules on it. It's still a Roth IRA account, so the tax benefits don't change, how you contribute doesn't change. What does change is what you're allowed to invest in. Typically, when you set up a Roth account through a brokerage, you're allowed to invest in stocks, ETFs, mutual funds, and the products that the brokerage account sells. With a self-directed Roth IRA, your investment options expand. You can now invest in things like real estate, precious metals, cryptocurrency, private notes, private money lending, all sorts of things. You're not limited to the basic public markets anymore. So if you buy a rental property in your self-directed Roth IRA, the title will reflect your IRA as the owner, not you personally. The income you make from your property would go directly into your self-directed account. Likewise, the expenses need to come from your self-directed account, not your personal account. It's important not to mix your personal funds with your self-directed account funds. This is where a lot of people get in trouble. Your account gives you control, but does require some discipline. One type of investment that really attracts a lot of attention is private money lending. Instead of buying the actual real estate, what you can do is you can lend money to the real estate investor. The real estate investor is maybe a fix and flipper. They buy the property, they renovate it, they sell it, they pay off the loan. You earn interest on the loan. You don't have to manage the project. The interest you earn goes back into your account. Your account starts to grow, and over time, this can be a really powerful way to build up your account, tax-free. There's a couple ways you can do this. You can underwrite the deal and originate the loan yourself. A second way to do this is to invest alongside with somebody else who's already doing it. Maybe it's another private money lender, maybe it's a hard money lender, some institution. In any case, you're the capital investor, you're not the person running and operating the project. Self-directed Roth IRAs do come with some strict IRS rules. There's a few things you cannot do. You cannot lend to yourself. You cannot personally guarantee your loans. You cannot invest with close family. You cannot personally benefit from the assets inside your account. And with small exceptions, you cannot invest in collectibles. Exceptions would be like precious metals, things like that. These would be considered prohibited transactions, and violating these, the IRS can disqualify your account. So while these accounts are more flexible and do offer you more investing opportunities, it is important to get familiar with the rules so that you don't get disqualified. So self-directed Roth IRA accounts make sense if you want more control, if you understand alternative investments, if you're comfortable with the responsibility. It may not make sense if you want a simple passive investment like a mutual fund. If you're not okay with a little extra paperwork, if you don't want to assess deals or invest in alternative assets. These accounts aren't necessarily better than a Roth IRA, they're just different. They offer more opportunities, more options to invest, different asset classes in which you can take advantage of. Well, thanks for making it to the end of this video. I hope this information is helpful to you. Remember, I am not your financial advisor, but you can take these ideas to your financial advisor and come up with a plan to better your retirement. Thanks for watching. Follow for more.